everyone, my name is Mai Anh Dao with student ID BABAIU23049. Today I am very happy to present in the course e-commerce under the guidance of our lecturer Ms. Nguyễn Hồng Anh. The topic of my presentation is mobile payment, fintech versus the bank chance. My talk will last around 9 to 10 minutes. If you have any questions, please send me a via email at the end of this video. Now to begin my talk. To structure my presentation quickly, I will begin with a short summary of the case to set the context. After that, I will move on to focus questions. Before we dive into 4 questions, let me briefly summarize the case so that we all set the same background. The case mobile payments, fintech versus the bank channels is about the competition among fintech startups, tech giants, retailers, and traditional banks in the fast-growing mobile payments market. By 2022, the U.S. market reached $1.5 trillion with $1.1 trillion from P2P transfer and $415 billion from proximity payments. Fintech firms like BABAIU, Square were early innovators, but they struggled as a big tech. Apple, Google, Samsung, and PayPal leveraged their ecosystem and resources to dominate the market. Retailers such as Walmart and Starbucks launched branded quality tied to loyalty programs, while banks respond with Zelle, a peer-to-peer service integrated into banking apps. Zelle grew rapidly, reaching nearly 62 million users by 2022. The case also that adoption is led by millennials and Gen Z, while other generations remain cautious. Challenges include low merchant adoptions, too many competing apps, and ongoing concern about security. In short, the case illustrates how fintechs back innovations, but big tech and banks with scale and trust. Now let the mobile payment landscape. With the overall picture in mind, let us now turn to specific questions one by one. Let's discuss the 3 main types of mobile payments as identified in the case study. The first is Universal Proximity Payment System. This uses technology to make payments at many participating merchants. Examples include Apple Pay, Google Pay, and Samsung Pay. They are widely accepted and highly secure, often using biometric authentications. The second type is Brand Proximity Payment System. These are tied to a specific retailer ecosystem, such as Walmart Pay or Starbucks mobile app. They can only be used within that brand store, but they often include loyalty reward and personality promotional. Finally, peer-to-peer payment system. This enables direct money transfer between individuals, such as BABAIU, Zelle, and Square. They are especially useful for splitting bills and sending money to friends and family. In short, the 3 types differ mainly in their scope of use, their target user, and their level of brand integrations. More recent data show that in 2024, mobile wallets reached over 5 billion global users, accounting for about 31% of in-store retail transactions. This confirms that tap-to-pay is steadily replacing cash and cards. Having explained the 3 main types of mobile payments, the next question naturally is which age groups adopt mobile payments most and why? The case highlights that millennials and Gen Z are the fastest adopters of mobile payments. Over 70% of millennial smartphone users make P2P payments in 2022 compared to just 38% of baby boomers. This generation gap shows that younger users are leading to the cultural shift. There are 3 main reasons. They are daily smartphone users comfortable with downloading apps and trying new technologies. They value convenience and speed, preferring cardless transactions over traditional methods. They are more open to technology and less try to habits like using text or cash. More recent survey reference in the pattern. In 2025, around 56% of U.S. consumers use Venmo, Zelle, or PayPal at least once a month, with 41% of Gen Z and 37% of millennials using them weekly. By contrast, baby boomers remain cautious, with only 15% using mobile wallet weekly. This shows that younger generations are not early adopters, but also frequent users, driving overall growth in mobile payments. Now that we know which age groups are driving adoption. Let us analyze which fintech startups have struggled against big tech in the high competitive market. Technology giants have powerful ecosystems. Apple, Google, Samsung control smartphone hardware and software, making it easy to integrate payment services directly. In 2022, Apple Pay has around 45 million users, Google Pay about 25 million, and Samsung Pay about 40 million, number as most startups cannot match. Financial resources. Big tech can invest heavily in security, partnership, and marketing, something most startups cannot afford. The case not that Venmo, despite its success, was acquired by PayPal, showing how fintech often get a start rather than compete independently. Apple Pay leveraged the iPhone NFC, and Google Pay is pre-installed on Android devices. Meanwhile, fintech startups start from scratch, struggle to build trust, face limited marketing budgets, and lack of the same risk as tech giants. As a result, competition is highly unbalanced, and many fintech firms choose to collaborate instead of directly competing. Recent data confirm this dominance. By 2025, Apple Pay reached 65.6 million active users in the US, while Google Pay had about 35 million, giving them nearly 80% of the mobile wallet market combined. At the same time, the average American makes 11 mobile payment transactions per month in 2024 compared to 34 per month in 2018. This illustrates how deeply mobile payments have become part of everyday life, leaving startups at a clear disadvantage. Finally, after looking at the challenges fintech face, we can explore a concrete example of success in this space, Seal, and the reason for its rapid rise. According to the case, Seal is a peer-to-peer digital payment service originally founded in 2011. As glitch is trained by a consortium by a US bank. It was rebranded as Seal in 2017. Unlike independent fintech apps, Seal is integrated directly into mobile banking apps from more than 10,000 financial institutions. Users only need to receive email or phone number to send money, and transfer are completed almost instantly. Payments are free and usually route directly from customer checking accounts. Seal has grown rapidly for several reasons. It leverages consumer trust in its bank and does not require downloading a separate app. Transfers are faster than competitors like Venmo and Square Cards, which can take up to a day. It has a large financial network supported by Visa or MasterCard and connected by existing banking services such as bill payments and check deposits. Compared to B2B services like Venmo or PayPal, Seal's main advantage is its strong connection with the banking system. The case showed that by 2021, Seal processed over $365 billion in transactions, compared with $210 billion for Venmo. And by 2022, it had nearly 62 million users, representing more than 40% of P2P payment users in the United States. More recent data reinforced this success. By 2024, the annual transaction volume exceeds $500 billion, maintaining its lead over Venmo and other fintech rivals. In 2025, industry reports estimate that nearly half of US adults use Zelle at least once a month, confirming that its combination of speed, strength, and accessibility has made it the dominant P2P payment service in the US. Having answered four questions, I would like to conclude with the main insight we can draw from this case and from update data. Mobile payments fall into three main types, with universal and P2P payment driving much of today's growth. Millennials and Gen Z are the leading adopters, using mobile payment frequently and shaping the market directions. Fintech startups face major challenges competing with big tech ecosystem, resources, and integration advantages. Seal illustrates how leveraged banking network and customer trust can lead to rapid expansions. And here is some of my references, Arc 5. That's at the end of my presentation. Thanks for listening.